So now it's official, we are in a bear market. I know, it sucks, we lose a lot of money, the market is down, and you kind of feel probably that there's no place to hide right now. Today, we're going to look at how you can invest during a market crash. Most importantly, how you should manage your portfolio throughout this storm. Dividend investors, bonjour. My name is Mike Hiroux, and I'm the founder of Dividend Stocks Rock, and I'm also a passionate investor. I host this YouTube channel to help you invest with more conviction so you can enjoy your retirement. And right now, I must be honest, it should probably be very hard to enjoy your retirement when you have a chart like this one. Canadian market has been almost in positive territories. Why? Because they can count on the energy sector in commodities. But besides that, everything is pretty much a downslide. The S&P 500 is down. The Nasdaq is in bear territory for a while. And it's kind of hard because we have bad news about interest rates, bad news about inflation, bad news about pretty much anything, economic growth and so on. So we kind of feel that we're probably about to enter in a recession at one point. That could be also a risk. The market is super nervous. There's a lot of new investors that started investing a few years ago that probably never went through this bad period of investment. So we're going to see what we can do at this point. The first thing I have to tell you is not to panic. When you look at this graph, we see TFI International. The stock is down 30%, and I'm receiving a lot of questions at DSR about TFI. Say, okay, so the stock is down like this. Is it going to continue like even lower? And what's going to happen with the stock? Should I start selling and cover protect my capital and just like take the loss and move on? So you look at the stock price. It seems that it's going to go down and down and down. However, if you look back in history, and you should look back also to know if TFI has a strong investment thesis and why you bought that stock in the first place. So the first thing to do whenever you see a loser in your portfolio is go back to your investment thesis. Look back at TFI and ask yourself, okay, did I add this company to my portfolio because it's one of the largest trucking company in North America? It's operating in a highly fragmented market, and they have built such an amazing expertise with mergers and acquisition to grow their business. And whenever the market is down, whenever the economy slows down, they make even more purchases. Are those part of the reason why you invested in TFI? If yes, well, all of those reasons are still valid today. Actually, if you look back in time, we had a similar situation back in 2015, 2016, where the stock price dropped by about 30% as well because of a fear of recession. We had an oil bust back then, and it was not like good news at that point. Stock price was super low, and imagine that you would have sold that stock at that time. You would have missed an opportunity to show a 323% total return after this next 7 years. So all of that because over the past of 9 months, you would have lost 30%. As we are right now, you would have sold those shares because you're just feeling that you're going to lose a lot of money, and you just go with panic instead of putting everything in perspective and understanding what's happening. So I get it. Right now, stock price is down. It sucks. It feels bad, but in the end, if you hold great companies in your portfolio and they still meet your investment thesis, it's just a matter of time, and be a little bit more patient. One thing you should do right now, even if you started to lose money from the peak level of January 2022, is to look at your sector allocation. You know, sector allocation is everything. Most of the time, it will show you either asset allocation or sector allocation will explain most of your return. So if you're more geared toward an income phase, you want stability, maybe you're retired or about to retire, sectors like consumer staples, REITs, healthcare, and utilities will bring back some good dividend and will be relatively stable. They're like businesses that are easy to understand, especially with consumer staples. We have like all those products at home, and people, recession or not, they must wash, they must clean their house, they must eat, and so on. So those are very easy to understand businesses. They will be a great source of stability and income in your portfolio. If you're looking for both, then you can have financial communication services, especially in Canada. Canadian banks and telecoms, they're just amazing. They offer you a good yield and some valid growth at the same time. So you're thinking about companies like TELUS or National Bank, Royal Bank, TD Bank, well, pretty much any Canadian banks of the big six. They will bring you a yield over 3%, but some solid dividend growth at the same time. So that's the best of both worlds. You can also find interesting picks among industrials. Some are very stable and will be there forever, like Canadian National Railway, for example. So you can find both growth and income at this place too. If you're just going after growth, well, right now it's probably the time to buy a little bit more of consumer discretionary since there's a lot of fear about the recession, their margins getting squeezed, inflation is tough. Well, consumer discretionary stocks are down. Information technology, same thing. I don't have to tell you about the NASDAQ right now, right? So those are two sectors that could be quite interesting. And if you want to put a little bit more spices in your portfolio, you can also go with energy and basic materials. They are not my favorite sector, mostly because they make very poor dividend grower over time. Right now, they seems like the eighth wonder of the world, especially for the oil and gas industry. I'll give you that. But keep in mind that the dividend growth over the past 10-15 years for most of those stocks hasn't been incredible. Sure, you have some exception, Enbridge, TC Energy, Canadian National Resources, Imperial Oil. Those have been very stable and very interesting picks. So that could be your easy way to add some inflation protection, but not getting too much of that volatility. That could be a kind of like an interesting point. But besides that, tread carefully. Those companies, they all depends on commodity prices. And I know you're going to see and read a lot of documents and research telling you that the oil price will continue to rise. But keep in mind that those articles were also very popular in 2010. And we haven't seen an oil barrel at $200 since then, even though they told you that we were running out of oil. That was like 15 years ago. So one last comment about sector allocation at DSR. We focus on having at maximum 20% exposure, 25% if you're well diversified into one sector, your favorite one. And after that, you try to have like at least 8 sectors to have like a good diversification, anything between 5 to 10% in each of them. That's ideal. Why? Well, imagine that at the end of 2022, had a huge concentration in information technology because they were amazing companies. They've been thriving for so long and you haven't rebalanced your portfolio. Well, then you got hit like there's no tomorrow over the past few months. If you had sold 10% of your portfolio back in December, you would have rebalanced your portfolio. And yes, you would have taken a hit, but it would have been less hard on your value. That goes for all the sectors. Canadian banks could be hit tomorrow morning. Consumer staples could be hit tomorrow morning. We've seen that REITs are not having a good year so far. So yet, while they provide value, the market is concerned about rising interest rates and their debt level. So all of those reasons, sometimes you just invest in a bad sector. You cannot know that in advance. So having 8 to 9 sectors across your portfolio, 5, 10, 15% in each of them will help you to make sure that it goes through any kind of storm. Speaking of storms, if you are wondering what to do with inflation, in our DSR Recession-Proof Portfolio Workbook, 2002 edition. It's a free workbook. You can just click and download it from the link in the description below. Now we're up to 75 pages. So every single year I upgrade the workbook. I put more stuff in it. You have a bunch of questions to help you manage your portfolio, understand what's happening with your investments. And now we have a section about inflation because now it has been a big concern. One graph that you're going to find in that book is the Morningstar study. They were showing us how each asset class perform during high period of inflation. So we had the 70s and the 80s in there. Since then, I mean, past since the 1991 up to recently, we had basically no inflation. It was like 2%, 1%, 1.5%. So not much to worry about. But now these days, we're all going to freak out. A lot of people talk about stagflation period in the 70s where gold was the amazing safe haven that everybody was looking for. Well, as you can see in the other two period of high inflation, or right now, if you look at what happened between the start of the pandemic as of today, gold hasn't been that protector against inflation that much. However, commodities did well. REITs did well as well, and stocks, depending on which kind of stocks it works and not work that much. For commodities, that makes sense. It's at the center of inflation. Whenever commodity price rises, everything else will follow. So it's a great way to protect yourself against inflation. The problem with commodities is you will suffer from a lot of volatility. So if you're in for a good roller coaster ride, makes sense. If not, you might want to look into REITs. REITs, why? Well, it's quite simple. They have the ability to pass increases of expense to their tenants. Most of them has contracts with escalator clauses, meaning that the rent will increase every single year. Some of them are completely linked to inflation. Some others has a predetermined increase, but in both cases, they are able to increase their revenue organically every year without doing any other projects. As for stocks, well, my solution is definitely focusing on dividend growers and initiators. As you can see on this graph from Ned Davis, they have better returns, lower beta, lower standard variation. So what it means is low volatility, higher returns, more money in your pocket, less stress. This is what I like about dividend growers. So if I have to protect myself against inflation, if I'm worried about a potential market crash, I'm going to focus most of my money in dividend growers. How can I find them? Well, I will start with what I call the dividend triangle. The dividend triangle, quite easy to understand. There are three metrics and I'm looking at the trend. The first one, I want straight revenue growth. As you can see from National Bank here, it goes up all the time. This is what I want. I want a dominant player in the market that has a lot of growth vectors, maybe mergers and acquisition, R&Ds, organic growth, popular products, some pricing powers. This is what you're looking for revenue growth. After that, you will look at earnings per share growth over the same 5 years. You want a company that has healthy margin, strong pricing power, and they're not only making sales, but they're making some profit. Yes, earnings are not perfect. They're based on accounting principles, but it's hard to trick it for 5-year period. As you can see on this graph for National Bank, we have a dip during the pandemic. So whatever happens there, you have to look into the quarterly statements. But looking at dividend triangle will give you the invitation to investigate right away. We know the story here. Provision for credit losses increased a lot due to pandemic. Banks were not sure about their loan and possible of default, so that hurt earnings temporarily and then they went back up. So at least you understand, you can explain what's happening there, and if it feels right, you can move on to the third metric of the dividend triangle, which is the dividend growth. Quite easy, right? Again, here we want to find companies with increase every single year. The longer the better, but I would not discard a company that shows 3 or 4 years of dividend increase just for the sake that I'm missing some history here. Sometimes this is the beginning of a great story. Imagine when I pick up Apple in 2014, was exactly the case. Here, again, with the fluctuation of the dividend growth, we can clearly see that there was a pause. So now you dig further, you realize that regulators said no more dividend increase for the financial services until the pandemic is under control. That was fine. It's okay. We have a good explanation. So then we can move on. So this is a great example of a strong dividend triangle. Now, I know that when you look at your portfolio, especially if you look day after day or week after week, you kind of feel that there's a lot of panic right now. So this is probably where we at. I've taken the example here on this graph of how the market reacted during the financial crisis of 2008, 2009. So at first we have a slowdown. So we're thinking there's something that isn't right. Maybe we're heading to a recession. Maybe something is wrong. I'm not too sure. So that was probably like the beginning of January. Now we kind of getting into panic mode where the market crashed, and this is where it hurts. A lot of people sell and they're just freaking out. There's a lot of margin calls for institutional and hedge funds, which pushes the market even lower faster. And this is what happened in 2008. After that, once the dust has settled, there's kind of like what we call a market fatigue. Market doesn't care anymore. Investors are just like, oh, you know what? That's a bad market. There's nothing to do here. So I'm holding on to my position. Lower volume, not too much volatility. It's pretty much stable, but it's not positive. So we have those three phases. And then eventually what's going to happen? It's going to go back up. So you really have to be careful about what you do next. You really have to reconsider your portfolio as a whole. Again, I strongly suggest that you download my free workbook. It's going to walk you step by step, doing the complete analysis of your portfolio, how to select the right stocks, what to do with your losers. Some of them you will keep them, some of them you won't. And as a final graph today, I just want to show you how perspective is different from one place to another. If we go back in time in 2017, the market was overvalued. There was no value in there. We should not invest into it because it was an all-time high and it was nearly impossible to generate more growth. Then, you know what? Well, it kept growing in 2018 until it reached a point where we have a quick bear market. So at the end of 2018, we were down about 20% from peak level, roughly down 10%, 8% for the full year. And then people were just thinking, oh, I'm just going to continue to wait. I'm going to wait because now it's the beginning of the end. And later on, I'm going to be able to catch the bottom. Well, unfortunately for you, the bottom was on December 26th. So instead of spending time with your family, maybe getting some gifts or giving some gifts while you were on the market and buying, good for you. If not, you missed the opportunity. As you can see, it went right back up. 2019 was one of the best years of that decade, and we all know what happened after that. During the month of March of 2020, when the pandemic hit, we had a massive market crash, and then people were saying, oh my God, that's the best deal ever. Funny enough, when you put that into perspective, it was pretty much the same level as 2018 and pretty much the same level as 2017. So in the end, you're paying the same price. Once you think it's a deal, the other one think that it was the market that was overvalued, but it was pretty much the same price. So if you do your investment thesis, you have a solid sector allocation and you stick to your plan, you're going to be good no matter what happens next. So it's about the long term, not about the next few months. I hope that have helped you invest a bit more with conviction today, that have maybe reassure you about your strategy. Maybe you need one and you have to like dig a little bit deeper. The workbook is for you then. Again, click in the link description below. You can download the free workbook, no strings attached or anything. You'll just have these free resources that have helped our members at Dividend Stocks Rock for the past 3 years now. And it's always a good read if you want to have some good refresh about all aspect of your portfolio. So give me a thumbs up, subscribe to the channel, and don't forget to stay invested.